Thank you for joining us today for our results briefing. My name is Hiroyuki Yamada of Yamaichi Estate Co. Limited. Today, I will present an overview of our financial results for the fiscal year ended March 2026, followed by our earnings forecast for the fiscal year ending March 2027, as well as our medium-term earnings plan. There are three key points I would like to highlight today. First, although net sales declined this fiscal year, operating profit increased, reflecting an improvement in profitability. Second, starting next fiscal year, large-scale projects are expected to contribute more fully, and we plan to achieve record-high net sales and the highest operating profit since listing. Third, I will outline our medium to long-term vision and emphasize that we are not a mature company, but a growth-oriented company still in a phase of development. Please note that the information presented today is based on information available to the company and judgments made by management as of May 26, 2026. Let me now go over the details. We will begin with our consolidated results for the fiscal year ended March 2026. Net sales totaled 17.6 billion yen, representing a year-on-year decrease of 15.6%. On the other hand, operating profit reached 1.9 billion yen, marking a 10% increase year-on-year. This lower net sales but higher profit profile characterizes our performance this fiscal year. Net sales declined mainly due to the condominium segment. Supply fell from 8 buildings or 237 units in fiscal year 2025 to 5 buildings or 119 units in fiscal year 2026. However, this decline does not reflect a slowdown in demand, but rather the impact of development schedules and the timing of project completions. Looking ahead, we expect a strong recovery next fiscal year, driven by the completion of several large-scale projects. On the profit side, high-margin projects in the real estate development and sales segment made a substantial contribution. In particular, projects involving property rights coordination for corporate real estate progressed ahead of schedule, and improvements in cost ratios for detached housing also contributed, enabling us to maintain a high level of profitability. As a result, operating profit increased significantly. On a net income basis, net income declined due to factors such as goodwill impairment associated with structural reforms at a subsidiary. However, on an operating profit basis, we see our underlying profitability steadily improving. Now, let me go over our performance by segment. First, in the real estate development and leasing segment, existing properties performed steadily, and the opening of new roadside retail properties also contributed to earnings. The operating margin exceeded 30%, and this segment continues to function as a stable source of recurring earnings. Next, in the real estate development and sales segment, both net sales and operating profit increased significantly. This was driven by progress in property rights coordination projects for corporate real estate. I will provide further details on this in a later slide. On the other hand, in the condominium segment, both net sales and operating profit declined due to the decrease in the number of units supplied. However, this is attributable to temporary factors, and we expect a recovery from the next fiscal year onward, supported by the completion of large-scale projects in the Tokyo metropolitan area. This slide illustrates our core strengths. We are not merely a company that purchases land and constructs buildings. Rather, our strength lies in maximizing land value by addressing complex rights-related projects through negotiations with landowners and tenants, as well as securing the necessary permits and approvals. In general, such projects require significant time and effort and are often avoided by many companies. However, this results in limited competition, enabling us to acquire land at appropriate prices. This fiscal year, our strategy and expertise were fully demonstrated, leading to an improvement in profitability. This slide presents a roadside retail development project we undertook this fiscal year in Sakurai City, Nara Prefecture. We execute the entire process on an integrated basis, starting from undeveloped land, including the consolidation of multiple landowners, obtaining permits and approvals, development, and tenant leasing. For this project as well, we developed the project from undeveloped land and successfully achieved tenant openings. As a result, this project has contributed to building a stable earnings base through long-term lease agreements. Next, I will explain our financial position. Total assets amounted to 62.5 billion yen, representing an increase of approximately 11.8 billion yen from the previous year. The primary driver of this increase was the accumulation of inventories, mainly reflecting acquisitions of development land in the Tokyo metropolitan area. We are currently transitioning from an investment phase aimed at the future monetization of large-scale projects to a harvesting phase. In addition, the share of projects in the Tokyo metropolitan area, our key focus area, has been increasing, and we expect this to serve as a key growth driver going forward. Borrowings have also increased. However, this is associated with development investments made with a view toward future monetization. We will continue to manage the business with a focus on maintaining a balance between growth investments and financial discipline. Next, I will explain our earnings forecast for the fiscal year ending March 2027. For the next fiscal year, we forecast net sales of 31.3 billion yen and operating profit of 2.8 billion yen. This would result in record high net sales and the highest operating profit since listing. The key driver behind this is the full-scale monetization of large-scale projects in which we have been investing. In particular, we plan to deliver a large-scale industrial land project within our real estate development and sales segment. In addition, in the condominium segment, we expect a significant recovery, driven by the completion of large-scale projects in the Tokyo metropolitan area. While there are uncertainties such as developments in the Middle East, we have formulated our plan based on what can be reasonably estimated at this point in time. This slide presents our segment outlook for the next fiscal year. The real estate development and sales segment is expected to remain a major driver of profits. In particular, the monetization of a large-scale industrial land project is expected to make a significant contribution. In addition, in the condominium segment, we expect a recovery in profits, partly reflecting a rebound from this fiscal year. The real estate development and leasing segment is expected to continue delivering stable performance. As a company, we aim to build a well-balanced profit structure supported by multiple segments rather than relying on a single segment. This slide illustrates our quarterly profit outlook. In our business, quarterly profits tend to fluctuate depending on the timing of large-scale project deliveries. For the next fiscal year, large-scale projects are concentrated particularly in the fourth quarter. However, depending on the progress of negotiations, the timing of sales recognition may be brought forward. Accordingly, rather than focusing on a single fiscal year or a single quarter, we place importance on enhancing corporate value from a medium to long-term perspective. Next, I will address shareholder returns. For the fiscal year ending March 2027, we plan to pay an annual dividend of 31 yen per share, representing an increase from the previous year. While continuing to pursue growth investments, we maintain a policy of providing stable dividends. In addition, we will continue our shareholder benefit program and place importance on strengthening relationships with shareholders over the medium to long term. Next, I will explain the real estate market environment and our management strategy. In the current real estate market, conditions remain challenging with rising construction costs, increasing interest rates, and intensifying competition for land acquisition. However, rather than competing on the construction side through scale, we have adopted a strategy of securing a competitive advantage on the land cost side. In other words, by focusing on areas that are difficult for other companies to enter, such as land rights coordination, securing permits and approvals, and changes in land use, we are able to achieve high profit margins. In addition, investment demand in the Tokyo metropolitan area remains strong, particularly among high net worth individuals, and we are concentrating our resources on this key area. This slide outlines our positioning. We do not pursue a strategy of competing head-on with major developers. Rather, we focus on areas characterized by high complexity and limited competition. In other words, rather than pursuing projects that anyone can undertake, we focus on projects where complexity creates value. As a result, we have established a business model that enables us to secure high profit margins while controlling land acquisition costs. This slide outlines the background of the investment real estate market we focus on, as well as changes in investor demand. First, in terms of the market environment, while Japan's population continues to decline, the number of high net worth households is on the rise, and our target market itself is expanding. In addition, against the backdrop of inflation and changes in the interest rate environment, demand for asset preservation and inflation resilience is also increasing. Whereas investment had traditionally focused on capital gains and large-scale projects, there is now a shift toward prioritizing stable income returns, leading to growing interest in real estate as a tangible asset. In response to these market changes, we view this as a growth opportunity and aim to achieve medium to long-term growth by supplying income-generating real estate with stable returns. This slide explains our target market and business positioning. Our focus is on mid-sized income-generating real estate in the range of approximately 500 million yen to 1.5 billion yen, which is closely aligned with real demand. Within this segment, there is a broad base of investors, including regional business owners, high net worth individuals, mid-sized real estate investment firms, as well as private funds, who prioritize stable income and long-term ownership. In response to these investor needs, we plan to expand the supply of diverse asset types, including studio apartments in urban areas, hotels, income-generating residential properties, as well as wooden apartment buildings in suburban areas. As shown at the bottom of the slide, our key differentiator is that we primarily target investors who prioritize stable income rather than short-term trading. As a result, our business is relatively less affected by economic fluctuations, and we continue to focus on the mid-size segment while capturing stable, real demand-driven investment demand. We place importance not only on flow-based earnings, but also on recurring earnings. Our basic policy is to achieve a balance between growth driven by development profits and stability supported by recurring earnings, primarily from rental assets. NOI from our owned assets continues to accumulate, strengthening our resilience to economic fluctuations. In addition, our real estate holdings include a certain level of unrealized gains, which contributes to flexibility in our financial strategy. The theme of our medium-term earnings plan is the transition from the investment phase to the harvesting and growth phase. For the 3-year period from the fiscal year ending March 2027 to the fiscal year ending March 2029, we are planning cumulative net sales of 92.7 billion yen, an operating profit of 7.6 billion yen. Large-scale development projects that we have steadily built up are now entering the monetization phase. At the same time, we will further strengthen our presence in the Tokyo metropolitan area while continuing to expand stable, recurring earnings. Please note that our assumptions for large-scale projects are based only on projects for which land has already been acquired or where acquisition is highly probable. Accordingly, our plan may vary depending on future land acquisition progress. This slide illustrates our profit composition. As a company, we place importance on maintaining a balance between recurring earnings and flow-based earnings, rather than relying on any single business. While ensuring stability through recurring earnings, we also pursue growth driven by development profits. This dual-engine approach is a key characteristic of our business. This slide presents the schedule of our major large-scale projects. Multiple large-scale projects are currently underway, including industrial land development, hotel development, and large residential land developments with over 200 units. We are not merely a housing-focused company, rather, we operate across a diverse range of asset types. These projects are primarily concentrated in areas where our expertise can be fully leveraged, such as high-complexity development projects involving significant permitting challenges and those requiring complex rights coordination. Next, I will explain our financial strategy and shareholder return policy. Starting with the financial strategy on the left, we do not pursue simple expansion in scale. In the real estate industry, increasing borrowings can lead to growth in assets and net sales. However, we believe that this alone does not necessarily translate into shareholder value. While continuing to expand our portfolio of rental assets and strengthen a stable earnings base, we remain committed to management that emphasizes capital efficiency and financial discipline. Specifically, we aim to maintain an equity ratio in the 21% range, control the debt-to-equity ratio at around 3 times, and target an ROE of around 8%. Our policy is not merely to expand our asset base, but to achieve a balance between growth and efficiency. Turning to shareholder returns on the right, while continuing to make growth investments, we place importance on maintaining a balance with shareholder returns. We plan to increase dividends from 31 yen per share for the fiscal year ending March 2027 to 33 yen by the fiscal year ending March 2029, and to continue providing stable dividends. In addition, we target a DOE of approximately 2%, adopting a structure designed to avoid significant fluctuations in dividends even when earnings vary. This approach is based on the concept of enhancing corporate value over the medium to long term and delivering those gains to shareholders in a stable manner rather than reacting to short-term earnings volatility. Going forward, we will continue to enhance corporate value by maintaining a balance among growth investments, financial soundness, and shareholder returns. This slide presents our long-term growth vision. We aim to achieve net sales of 100 billion yen and recurring earnings of over 5 billion yen by the fiscal year ending March 2036. In other words, we are not satisfied with our current position. Rather, we have a long-term vision based on proactive growth investments aimed at enhancing corporate value. However, we are not pursuing simple expansion in scale. Our core strategy is to achieve sustainable and non-linear growth by combining organic growth with M&A and new business initiatives. In the near term, we will focus on organic growth driven by our existing businesses, including real estate development and the accumulation of rental assets. We position the period from the fiscal year ending March 2027 through March 2030 as a harvesting phase, during which we will advance the monetization of projects we have built up while steadily expanding recurring earnings through the continued accumulation of rental assets. Beyond that, from fiscal year 2031 onward, we plan to transition into an accelerated growth phase by leveraging the development capabilities and know-how we have cultivated in regional markets and expanding them into the Tokyo metropolitan area. We aim to further enhance growth by strengthening real estate development as a key growth driver, while also utilizing M&A and new business initiatives. Another key feature of our strategy is that we aim not only for sales growth, but also for the parallel accumulation of recurring earnings from rental assets. By targeting both net sales of 100 billion yen and recurring earnings of over 5 billion yen, we aim to enhance corporate value while strengthening a stable earnings base. We are not merely a regional real estate company. By expanding the development capabilities we have cultivated locally on a nationwide basis, we aim to enhance corporate value over the medium to long term. Finally, I would like to present the disclaimer. The forward-looking statements discussed today are based on information available as of May 26, 2026. However, actual results may differ due to changes in the external environment and other factors. This concludes my presentation. Thank you very much for your attention today.